Hi, in this video I'm going to give a quick overview of the different types of businesses we can have. So when we talk about different types of businesses, we mean how a business differs in how it is owned or how it is operated. So in this video we will give a quick introduction to three different types of businesses. This is sole traders, partnerships and companies. We could further break up types of businesses into lots more ownership structures than this, but these are three key sort of overarching terms of businesses, and it's important to understand the difference between these at an introductory stage. So without further ado, we will start with a sole trader. And what we mean by a sole trader is a business which is owned and operated by just one person. So these sorts of businesses may not clinch the headlines, and they may not be the huge brands that we know, like our Nikes and our Adidases, but don't let that fool you in the fact that there are lots and lots of sole trader businesses out there. There are more than any other type of business, in fact, in terms of just lots of businesses that are owned and operated by one person, but they do obviously tend to be smaller businesses by this exact fact that they are owned and operated by one person. And a feature of a sole trader is that the owner is liable for any losses that the business makes, which means that if the business is hemorrhaging money and it's not, or its costs are much higher than its revenues, then the owner is going to tend to have to pay out of his own money to bail the business out. So the sole trader is completely liable for any losses that the business makes. So the key feature of a sole trader here being that it's just operated by one person, and it has the simplest form of ownership structure. And you may actually be a type of sole trader if you run your own very small business, but you may not think of it as being a business or yourself as being a sole trader. So the next type of business we'll get onto is a partnership. Now this is quite similar to a sole trader in that the business is owned and operated by the same people, but now we're thinking of a business which is owned by two or more people. And as the name suggests, we would say that these people are in a partnership. So again, similar to a sole trader, each partner is jointly liable for any losses the business makes. This means that if the business makes a loss, the owners, or the multiple owners, are going to have to tend to pay out of their own pocket, their own personal money, in order to pay off the losses of the business. This is slightly different because they're obviously jointly liable, so the owners can choose to split these losses between them however they see fit. But still quite a simple ownership structure that we just have a few people or 2+ people that own and operate the business, but now we just have multiple of them, so it is slightly more complicated than a sole trader. And moving on to the most complicated type of business is when we have a company. Now companies are a bit more complicated because they are owned and operated by different parties. So as we see here, a company is owned by shareholders, so who own shares in the business, which means they own a share of the business. However, these shareholders then elect directors who actually run or operate the business. So we have different owners to the people who are actually making the decisions on the day-to-day running of this business. The owners usually have limited liability here, which, if we explain that in the next point, which means that the shareholders, who are the owners, are only liable for losses up to the value of the shares that they own. So if we take a step back and consider that one of the owners, let's say that we have 10 owners, and let's just look at one owner who, say, owns £1 million of shares in a company. Even if the company in a certain year makes £10 billion in losses, the shareholder can only lose at most their shares in the company, which is £1 million. So they will not have to pay off all the losses of the company. they are only going to have to lose the number of shares that they have, and this is because if the business is losing £10 billion, the business will likely go bust and will then become worth nothing. So the shares in the company that were originally worth £1 million when they bought them are now worth £0. So at most, the owner has lost their £1 million shares. Your shares cannot be worth a negative amount, so there's no way that the owner can have to pay more than the shares they own. So this is what we mean by limited liability. The liability of an owner is limited by the amount of the firm that they own. And this point comes as a consequence of this final bullet point, that companies are a separate legal entity from their owners. So if a company makes these huge losses, as I used in this very simple example, then these losses are, let's say they belong to the company. So if a company is making these levels of losses, we can just wind down the business and liquidate it and say that the company's gone bust. We don't have to make individual people, the owners, bankrupt, because these are a separate legal entity. However, this is not a feature we tend to see with partnerships and sole traders. If you are a sole trader and you have your own business and it makes loads and loads of losses, you will tend to be liable for these losses, whereas with a company, this is usually not the case. So that is one key difference. Again, a big difference is that a company is owned and operated by different people, and the second difference is this separate legal entity. So as a consequence, we have limited liability. So hopefully that made some sense, and we've started to see some of the differences between different types of business, and we can start to think about how this might have a difference in the way we report our financials and the sorts of things we will actually need to report, because these businesses are owned in such different ways that they will have different aspects to their financial statements. But we will go into more detail on that in a future video. For now, if this was at all useful, please do drop a like rating, check out the playlist for more introductory accounting, and subscribe to add some econ to your subscription feed.